In 2005, Congress passed the Bankruptcy, Abuse Prevention, and Consumer Protection Act. Buried inside it was a provision that made private student loans nearly impossible to discharge in bankruptcy, joining federal student loans, which had already been exempt since 1976. Think about what that means. You can discharge credit card debt in bankruptcy. You can discharge medical debt. You can discharge a failed business loan. You can discharge almost any financial obligation in America through bankruptcy court, except student loans. The debt you took on at 18 to get the education you were told was mandatory for financial success is the only major consumer debt category in America with virtually no exit. A 2022 study by the Student Borrower Protection Center found that the average student loan borrower who entered repayment in 2010 still owed 90% of their original balance 12 years later. Not 90% of what they originally borrowed, 90% after 12 years of payments.
They had been paying for over a decade and barely moved the needle. According to the Federal Reserve, total outstanding student loan debt in America reached $1.77 trillion in 2026, spread across 45 million borrowers. The average balance per borrower is approximately $38,000. The median monthly payment is approximately $393. And the system that manages, services, and profits from that debt was built through specific legislative choices, specific regulatory decisions, and specific industry lobbying to ensure that repayment remains as slow, as expensive, and as difficult to escape as legally possible. This video documents exactly how that system was built, how it operates, and what borrowers can legally do to navigate it.
Data from the Federal Reserve Student Loan Research 2026, the Student Borrower Protection Center, the National Student Legal Defense Network, the Consumer Financial Protection Bureau's Student Loan Servicer Research, the Department of Education Income-Driven Repayment Analysis, the Institute for College Access and Success, and the New York Federal Reserve Center for Microeconomic Data. Federal agencies, academic institutions, and borrower advocacy organizations, not opinions. The single most powerful mechanism that makes student loans structurally difficult to repay is interest capitalization, a feature of federal and private student loans that most borrowers do not understand when they sign the promissory note and do not discover until years into repayment.
Here is how it works. During periods when you are not making payments, in school, during the grace period after graduation, during deferment or forbearance, interest accrues on your loan balance. That unpaid interest does not simply sit alongside your balance. Under most loan programs, it capitalizes. It is added to the principal balance at specific trigger points. Once capitalized, you now owe interest on your original loan plus interest on the previously unpaid interest. A borrower who takes $30,000 in unsubsidized federal loans at 6.5% interest, spends 4 years in school during which interest accrues but is not paid, and graduates with a 6-month grace period before repayment begins, enters repayment not with a $30,000 balance, but with approximately $38,000. $8,000 of capitalized interest added to the principal before a single repayment dollar is paid. They borrowed $30,000, they owe $38,000 before they make their first payment. On a standard 10-year repayment plan at 6.5%, their monthly payment on the $38,000 balance is approximately $431. Over 10 years, they pay approximately $51,720 in total, $21,720 in interest on a loan that was originally $30,000. They pay back 172% of what they originally borrowed. For borrowers who defer payments longer, for graduate school, for economic hardship, for the various forbearance options that servicers frequently steer borrowers toward, the capitalization compounds further with each trigger event. The CFPB found that student loan servicers systematically encouraged borrowers to enter forbearance rather than income-driven repayment plans during periods of financial difficulty, in part because forbearance generates more interest accrual and more capitalization events, increasing the total balance and the total interest collected over the life of the loan.
Student loan servicers, the companies that manage billing, payment processing, and borrower communication on behalf of the Department of Education, are paid per account, not per successful repayment. This payment structure creates an incentive alignment problem that has been documented extensively by the CFPB, the Department of Education's own Inspector General, and state attorneys general across multiple investigations. A servicer whose compensation depends on the number of accounts managed has no financial incentive to help borrowers find the fastest, cheapest path to repayment.
A servicer whose compensation is not reduced when borrowers enter forbearance, miss payments, or remain in extended repayment has no financial incentive to proactively inform borrowers about income-driven repayment plans, public service loan forgiveness eligibility, or other programs that might reduce the borrower's total cost.
The CFPB's 2022 report on student loan servicer practices found that servicers provided inaccurate information, failed to process income-driven repayment applications accurately, and steered borrowers toward options that increased total interest paid rather than options that aligned with borrower financial interest, across millions of borrower interactions documented in complaint data. Navient, one of the largest student loan servicers, settled a multi-state lawsuit in 2022 for $1.85 billion after attorneys general from 39 states alleged it had engaged in abusive servicing practices, including steering borrowers into forbearance instead of income-driven repayment, misrepresenting loan terms, and failing to accurately process payments. The settlement provided relief to approximately 66,000 borrowers, a fraction of the total borrower population affected by the documented practices. The servicer problem is not incidental to the student loan system. It is structural, embedded in a contract design that aligns servicer compensation with account retention rather than borrower financial success.
Income-driven repayment plans, programs that cap monthly student loan payments at a percentage of discretionary income and promise loan forgiveness after 20 to 25 years of payments, were designed to make student debt manageable for low and middle-income borrowers. The design has significant flaws that the Department of Education has acknowledged and partially addressed through recent regulatory changes. The fundamental math problem with income-driven repayment for borrowers with high balances is that a payment capped at 5% to 10% of discretionary income may not cover the monthly interest accruing on a large balance. A borrower with $80,000 in loans at 6.5% accrues approximately $433 monthly in interest. If their income-driven payment is $200 monthly, their balance grows by $233 every month they are enrolled, a phenomenon called negative amortization that was standard across most income-driven repayment plans until recent regulatory reform.
After 20 to 25 years of income-driven payments, the promised forgiveness arrives, but triggers a tax bill. Under current law, the forgiven balance is treated as taxable income in the year of forgiveness. A borrower who has $60,000 forgiven after 25 years of income-driven payments faces a tax bill on $60,000 of ordinary income, potentially $13,000 to $18,000 in additional federal tax due in a single year, on a year when they were not expecting a large tax obligation. The SAVE plan, the most recent income-driven repayment program implemented in 2023, addressed the negative amortization problem by covering unpaid monthly interest for borrowers whose payments do not cover accrual. Its implementation has been contested in federal litigation that has affected hundreds of thousands of borrowers mid-repayment, illustrating the instability of regulatory income-driven repayment structures that can change with each administration.
The bankruptcy exemption that opened this video is not the only legislative feature that makes student loans structurally different from every other consumer debt category in America. The Higher Education Act of 1965, amended multiple times since, established the framework that eliminated statutes of limitations on federal student loan collection. Most consumer debts become uncollectible after a statutory period, typically 3 to 10 years, depending on state law. Federal student loans have no statute of limitations. They can be collected indefinitely through wage garnishment, tax refund seizure, and Social Security benefit offset, without a court judgment.
The Social Security offset provision is particularly significant for the retirement discussion. The federal government can garnish Social Security retirement benefits to collect on defaulted federal student loans. The Government Accountability Office reported that approximately 114,000 borrowers had their Social Security benefits garnished in a recent year due to student loan default, including borrowers in their 70s and 80s whose retirement income was reduced to collect on debts taken decades earlier. The combination of no bankruptcy discharge, no statute of limitations, administrative wage garnishment without court judgment, tax refund seizure, and Social Security offset creates a debt collection apparatus unlike anything available to private creditors for any other consumer debt. These features were enacted through specific legislative choices made over decades, choices that the student loan industry lobbied for specifically because they eliminate the risk of uncollectible debt, making student loans among the most secure assets that lenders and the federal government hold. The system was not built for easy navigation, but specific strategies exist that dramatically reduce the total cost for borrowers who understand them.
1. Enroll in the appropriate income-driven repayment plan immediately if your standard payment is financially constraining. The Department of Education's StudentAid.gov loan simulator allows borrowers to model their repayment under every available plan and identify which produces the lowest total cost given their specific income, family size, and loan balance. This tool is free, takes approximately 20 minutes, and most borrowers have never used it.
2. Pursue public service loan forgiveness if you work or could work in a qualifying public sector or nonprofit role. PSLF forgives the remaining federal loan balance after 120 qualifying monthly payments, 10 years, while working full-time for a qualifying employer. Unlike income-driven repayment forgiveness, PSLF forgiveness is currently tax-free. For borrowers with high balances in public sector careers, this is the single most valuable federal loan benefit available, and historically, the most poorly administered, with the Department of Education implementing significant reforms following documented servicer failures that caused widespread incorrect denials.
3. Refinance private loans strategically, not federal loans. Refinancing federal loans into private loans permanently eliminates access to income-driven repayment, PSLF, and federal forbearance options. For private loans with high interest rates, refinancing to a lower rate through a private lender can meaningfully reduce total interest cost, particularly for borrowers with stable income and strong credit who do not need federal program protections. 4. Make interest-only payments during in-school and grace periods if financially possible. Preventing interest capitalization at the point of loan entry is the highest return student loan management action available to borrowers still in school or in the grace period. Paying $50 to $100 monthly toward interest during school prevents that interest from capitalizing into principal, eliminating the compounding effect that begins repayment at a balance significantly higher than what was borrowed.
5. File an income-driven repayment recertification accurately and on time every year. Missing the annual recertification deadline can trigger a return to the standard repayment plan with a higher monthly payment until recertification is completed. Servicers are required to notify borrowers of the deadline, but have documented histories of inadequate notification. Set your own calendar reminder 60 days before your recertification date, regardless of what your servicer communicates. The borrower who entered repayment in 2010 and still owed 90% of their original balance in 2022 did not fail to repay their loan. They paid their required monthly payment every single month for 12 years, and the system was designed to ensure that those payments barely reduced the principal they owed. The bankruptcy exemption that eliminates the exit, the interest capitalization that grows the balance before repayment begins, the servicer incentive structure that steers borrowers toward forbearance rather than efficient repayment, the income-driven repayment forgiveness that generates a tax bill on the year it arrives, the Social Security garnishment that follows borrowers into retirement. None of these are accidents of poor policy design. Each one was the result of a specific legislative choice made at a specific moment that served the financial interest of the institutions that hold and service student debt. 45 million Americans are currently managing this system. The majority of them do not understand the interest capitalization mechanism. Most have never used the loan simulator at StudentAid.gov. Most do not know whether they qualify for public service loan forgiveness. Most have never compared their servicer's recommendation against the full universe of available options. The system depends on that lack of information. Not through deception, the terms are disclosed. Through complexity, the terms are disclosed in a way that requires expertise to fully understand. You now have that expertise. Use every tool available. The system was not built for borrowers. The navigation strategies exist regardless. This channel documents the financial systems most Americans live inside without fully understanding how they work against them. Student loans, life insurance, banks, taxes, prescription drugs. No product recommendations, no affiliate links. Just the documented mechanics and the legal navigation strategies. If that is worth something to you, subscribe.